Oh, ladies and gentlemen, if I do this video and you happen to look at my face and I look a little disgusted, I'll go ahead and tell you why that is. It's about an 18-minute video. I just did it. Went to hit stop, end the video, my little program here, and it wasn't lit up as if I was recording. So when I hit the button, it started recording. I said, nah, I didn't just waste 18 minutes of my life talking and talking like I do for nothing. Yeah. Long story short, yeah, I just did an 18-minute video, and the microphone that I'm looking at right now was the only one that benefited from this. If I look a little disgusted in the face, it's why. But I don't mind doing it again because I love my peeps and giving out the information. So here I go again. Part 2 of the same video, should I say, that I missed. It was painful. It was a little painful. Thank goodness I haven't done that too often. I've done it in the past a few times. But granted, I've got like 2,600, 2,700 videos on YouTube now since I started. So that's not too bad of a, failure rate of bozo-ness. Two things I want to discuss. One from SRS Rocco report. Silver market set up for much higher price move than gold. And first, I want to start with this one, though. Bank for International Settlements, the BIS, the central bank, warns of looming debt bubble. And what happens when a debt bubble bursts? Well, I just want to remind you, and I know we can say, well, if that's because it was rigged or whatever, but it was after 2008, 2009 that precious metals hit their all-time highs again. Well, silver hit $50 again, and gold went into a new high, $1,900 in 2011. I do want to say that because if this happens again, and it's in an epic proportion compared to last time, and it will be, what might gold and silver do then, right? So when the central bank of central banks, BIS, comes out and says, got a problem with this looming debt bubble, that lets me know. Jay Snip, you got your silver supply? Yes, I do, of course. My people, hope you guys do too. Again, I feel bad for people who can't necessarily afford it. You're living paycheck to paycheck, but remember, an ounce of silver is, $18, and you can get them for a buck over spot, even less than that, 60 cents. Call it $19, even 20. I know you can squeak $20 out every now and then. Even the most poorest people of all that might be watching my channel. Even you can do that. Oh, I smoke cigarettes. Stop smoking. You're choosing to smoke. Oh, I have a cup of coffee every day. Kind you brew at home, or no, I got it at the store. See? Brew it at home. Brew it at home. Save a couple bucks. You eat out lunch every single day, like I do. Maybe don't do it as much. Cut back half, right? There's ways that you can save a couple dollars to, for your silver investment. And again, I know I harp on this over and over, but I'm telling you, it's important. It's one of those things you're going to look back on and say, man, if I missed it, it's like missing Bitcoin at $2. Man, oh my God. It's like winning the lottery. I mean, right now, you could sell right now at $1,000. But it's going to go higher. So what? You bought it for $2. Massive increase in price. Imagine having 100 of those things at $1,000. Well, 100 times 1,000, $100,000. And I feel that gold and silver are going to be in that position. They're going to. I can't tell you when. I don't know. But I really don't care because as long as I have, I'll keep buying more. So that when it does happen, it'll be even more powerful for me as far as, the price going up and what I actually own in, this wealth, if you will, precious metals wealth, which was just supposed to be protecting me, and that was it. But again, it's going to do more than protect you when the time comes. So it talks about this one article, the BIS. The next financial crisis is likely to revolve around how this debt burden is managed, warns Neil McKinnon, an economist with VTB Capital in London. In the UK, most crises are related to boom and busts in the housing market, where there's an approximate 18-year or so cycle suggesting that the next bust will be in 2025. That's quite a ways away, and for London real estate, they always have the Saudis, the Russians, and the Chinese to save them. But further south, in countries like France and Italy, credit downgrades are expected. And guess which southern country is back to giving us all headaches again? Greece. Greece is making headlines once more for its inability to work out a debt deal with its lenders. The IMF predicts that the Greek debt to GDP ratio is now at 180% and will soar to 275%. All the while primary fiscal surplus is currently at zero. So the general manager, Jamie Caruana, for the Bank of International Settlements, hinted in a speech on Brussels just on Monday that the core central banks might not know what they're in for. We need to escape the popular models that prevent us from recognizing the buildup of vulnerabilities, he said. He, or is it a she? Jamie could be a he or a she. Getting all the right dots in front of you does not really help if you do not connect the dots. Right now, I worry that even though we have no data on aggregate debt, we are not properly connecting the dots and we are underestimating the risks, particularly when the high levels of debt are aggravated by weak productivity growth in many countries, which, by the way, is happening as we speak, very weak productivity growth. The standard of evidence for precautionary action has to be the preponderance of evidence, not evidence beyond a shadow of a doubt. Waiting for fully compelling evidence is to act too late. And what do we do in this country? I'll tell you, because I just said it about 18 minutes ago, so I know exactly what I said. And that is, we're reactionary. Federal Reserve, react. We know we saw this coming. Mr. Bernanke, you didn't see the housing bubble. Nope, we didn't. Nobody, I don't know how anyone saw this coming. That's what he said on record. We didn't see it coming. Very few people did, said something, and they made tons of money because they played the opposite side of what was happening in the housing bust. Very few people. But they got it right. And the so-called experts didn't get it right. And the so-called experts had to play catch-up or reactionary. They reacted after the fact. They never do it in advance. So that's one little issue. Again, when the BIS says something, you may want to pay attention. That's the central bank's central bank. Which leads me to silver. SRS Rocco report. Silver market set up for much higher price move than gold. When the paper markets finally collapse, the silver market is set up for much higher price gains than gold. And why? Because the fundamentals show that precious metals investment demand has put a great deal more pressure on the silver supply than gold, and by a long shot at that. There are three crucial reasons why the silver price will outperform the gold price when the highly inflated paper markets disintegrate under the weight of massive debt and derivatives. While many precious metals investors are frustrated by the ability of the Fed and central banks to continue to prop up the markets, the longer they postpone that day of reckoning, the worse the collapse will be. Which means what? The better real assets will do. Like what? Precious metals? Well, that's one. Even Bitcoin, same thing. The first reason I wrote about in my article, critically high U.S. silver supply reliance in jeopardy when paper markets crack. The United States silver net import reliance as a percentage of total consumption was 72% versus 36% for copper and a negative 48% for gold. And that's just, it has a chart, which I don't have to show it. Just listen in on it. I'll cover it for you. This chart shows that the U.S. relied upon 72% of its domestic silver demand from foreign sources in 2015. Thus, U.S. silver supply reliance, 72%, is double that of copper, 36%, while U.S. gold demand enjoyed a 48% surplus versus its domestic supply. The second reason the silver price will surge higher than gold is due to the amount of physical silver in total ounces purchased by investors versus gold. From 2010 to 2016, investors purchased a total of 1.5 billion ounces of silver bar and coin compared to only 284 million ounces of physical gold. Thus, precious metals investors purchased 5 times more silver ounces than gold ounces during this 7-year time period. Of course, the total value of physical gold investment was much higher than silver during this time period, but this tremendous amount of silver bar and coin demand has impacted the silver market much greater than the gold market. This brings me to the third reason. Due to the huge amount of silver bar and coin demand since 2010, the silver market suffered a net deficit of 801 million ounces. However, the 284 million ounce of gold bar and coin demand did not impact the gold market the same way. According to World Gold Council, the World Gold Council, the gold market enjoyed a small 7.5 million ounce net surplus during this time period. While it is true that the World Gold Council may be underestimating Chinese physical gold demand and its impact on the annual surplus of deficit figures, a 7.5 million ounce surplus is only 3% of the 284 million ounce total gold bar in coin demand figure from 2010-2016. However, the 801 million ounce net silver deficit is more than 50% of total silver bar and coin demand during the same time period, which means physical silver investment demand is causing much more stress on the silver market than it is on gold. While the silver market has been able to supplement the annual deficits with old silver coin stocks in large bars that were liquidated during the 1990s, this is not an endless supply. Excuse me. According to the data I obtained from the GFMS team at Thomson Reuters, dumped a net 580 million ounces of silver bar and coin on the market between 1995 and 1999. Now, compare that to the past 5 years, right? 2012 to 2016, as investors purchased a net 1.152 billion ounces of silver bar and coin. And here's the clincher. From 1985 to 2007, the total net silver bar and coin demand was a negative 95 million ounces. Right, 1985 to 2007, okay? Which means investors sold a net 95 million ounces of silver bar and coin in that 23-year period. However, investors have purchased a net 1.785 billion ounces of silver bar and coin just from 2008 to 2016. 8-year period, not a 23-year period. This, he says, is a huge trend change. It's going to be huge. After the U.S. financial and economic meltdown in 2007, investors continue to purchase a record amount of silver bar and coin. This has put severe stress on the silver market, as the total net deficit since 2008 surpassed 1.155 million ounces, or 1.1 billion ounces, While the silver market will continue to supplement the ongoing annual deficits with old silver stocks, this supply is not endless. Furthermore, the days of the Trump stock market rally are numbered. But I will interject here and say, I don't think for a second they can't stretch us on until later this year, like September, October timeframe. You know, the September 23rd date stuff. Maybe this year is it. The last time the stock market crashed 2,000 points in the beginning of 2016, investors flocked into gold and silver in a big way. In conclusion, the fundamentals in the silver market are setting up for a much higher price spike than gold due to the 3 reasons stated in the article. The timing of these events is hard to forecast, as it is difficult to pinpoint when the Fed and central banks will lose control of their massive market intervention. My work is not meant to provide a short-term outlook on precious metals. Rather, it offers fundamentals that will win out over the medium to long-term time period. Precious metals investors need to look at buying and holding gold and silver the same way an individual puts money away each month in their 401k, pension plan, or retirement account. The difference, and I love this one, he ends this great, the difference between the precious metals investor acquiring physical metal compared to individuals acquiring paper assets or digits, is that one is real wealth while the other is an IOU. Those who transition out of paper digit IOUs and into physical gold and silver before the fat lady sings will be rewarded with much better options, is what he says. Can't agree more. Matter of fact, I wouldn't even be doing this video if I didn't agree with this. I absolutely love silver. And at one point in my life, years ago, I had a little bit of silver. I had a few of the 1/10 ounce. You know, the size of a freaking dime. They're like this big. Size of a dime. And in today's prices, spot price, 10th, about $1,225, $1.5, so that would be $125 roughly. Can you imagine paying $125 for a piece of metal? Okay, a piece of metal this big, right here. And of course, I chose the 1964 dime, which has 90% silver in it for this little demo. But I've decided after doing the research, I think I want to get rid of any little bit of gold that I have and just go all in silver. Not that I had a lot of the gold. I had just a few of these. And said, you know what? I'm gonna do it. I truly believe in silver so much. I see all these, again, fundamentals out the ears, and he just named a few. There's way more than that. Again, we have the manufacturing side of things. Products, new products. I keep doing the videos. Guys, here's a new thing. It uses silver. Oh, here's another one. Uses silver. Oh, guess what? I found another one. Uses silver. New things coming online. And that's on top of the massive, unprecedented investment demand in metals, precious metals, like silver specifically. That's why I keep harping on this over and over and over. If you don't have it, you must do what you can to get some. $18 silver. The day's going to come when you look back at $2 Bitcoin, like we did a $2 Bitcoin, $1,000. $2 Bitcoin, if I had 100 of those times $2, that's $200 it would have cost me. How much would have you had today? Oh, 100 grand. So wait a minute, you invested in something that cost you $200, and that something is now worth $100,000. Is that correct? That's a big 10-4. That is a big 10-4, good buddy. But I missed the boat, and a lot of you did too. But I saw the light, did the research. Okay, you know what? This may be digital ether digits, whatever the hell it is, but it's working, and it's not something the club can control like they can their paper markets, because there's no futures Bitcoin market where you can just print paper with the same underlying same Bitcoin. That's for 100 Bitcoins. No, it's actually for 100, but 1,000 people have the same contract, essentially, different contracts, all chasing that 100 Bitcoin, right? That would be a futures contract. These are not that way. You either buy them individually or you don't. This is a true market. And look what happens when a true market comes out. The club has an enormously hard time controlling the price. And $1,000 Bitcoin right now, I think, proves the case. Anyways, gots to go. Take care.